Have you ever just stopped and wondered why so many smart people make the exact same fundamental mistake when it comes to investing? Well, today we're going to dive into one of the oldest and frankly most frustrating puzzles in all of finance, the investor's paradox.
You know, on paper, investing seems so simple, doesn't it? The goal is crystal clear. Buy low, sell high. It's literally rule number one. But if we're being honest, for most people, the reality is often the complete, painful opposite. We find ourselves buying when prices are skyrocketing, and then panic selling after they've already hit rock bottom.
So that's the big question. Why? I mean, if the goal is so incredibly obvious, why do our actions so consistently let us down? It turns out the answer has almost nothing to do with spreadsheets or financial models, and everything to do with the ancient wiring of our own brains. And that's exactly what we're going to unravel together.
All right, our first stop is what I like to call the emotional roller coaster. Because you have to remember, markets aren't just numbers on a screen. They are giant arenas for two of our most powerful, most primal emotions, fear and greed. And the thing is, these feelings almost always show up at the absolute worst possible times.
It usually all starts with this one really powerful feeling: FOMO, the fear of missing out. You know the feeling. It's that anxious little itch you get when you hear stories about friends or colleagues making a fortune on some hot stock, and you just can't shake the feeling that the train is leaving the station without you.
And that FOMO, it quickly turns into pure greed. As the market climbs higher and higher, the news gets better and better, stories of easy money are everywhere, and this powerful sense of euphoria just takes over. Now, this is actually the point of maximum financial risk. But to our brains, it feels like the safest time to jump in. And so, driven by that euphoria, investors pile in, right at the very peak.
But what happens when the party stops and the market starts to turn? Well, all that euphoria vanishes and it's replaced by fear. The news turns ugly, the headlines are screaming crash, and just watching your account balance shrink is, well, it's painful. And to stop that pain, a huge wave of panic selling begins, almost always right at the bottom, which locks in the biggest possible losses.
Okay, so let's look at another powerful force that's at play here: our deep instinct to follow the herd. As social creatures, we are literally hardwired to look for safety in numbers. The problem is, in the world of investing, the herd is often stampeding directly towards a cliff.
And this herd logic is unbelievably persuasive. Think about it. When everyone around you is buying, it doesn't feel like you're taking a risk. It feels like you're making a smart, validated decision. Anyone who warns of a bubble is just dismissed as a pessimist. On the flip side, when the crowd is panic selling, the thought of buying feels completely insane. Our survival instinct is screaming at us to flee with everyone else, even if it means we're running away from the greatest opportunity.
So it's not just the external pressure from the crowd. Sometimes the most convincing tricks are the ones we play on ourselves. We call these cognitive biases. They're basically mental shortcuts our brain uses to make quick decisions. But when it comes to money, these shortcuts often lead us straight down the wrong path.
First up is something called recency bias. This is our brain's funny little habit of thinking that whatever has been happening lately is just going to keep happening forever. So if the market's been on a 2-year winning streak, our brain just assumes it's never going to fall. If it's been dropping for 6 months, our brain projects that trend all the way down to zero. We completely ignore long-term history in favor of whatever just happened.
Next, we have one of the most powerful forces in all of behavioral psychology: loss aversion. This is a simple but really profound idea that we human beings hate losing far, far more than we enjoy winning. The emotional sting of a loss is just so much stronger than the happy feeling of an equal gain.
Just how powerful is this feeling? Well, research has shown that the psychological pain of a loss is about twice as intense as the pleasure of an equivalent gain. Seriously, let that sink in. It's why finding 20 bucks on the street feels pretty good, but losing 20 bucks out of your wallet feels absolutely awful. This explains why we sell at a panic during a crash. It stops being a financial decision. It becomes a purely emotional one, driven by an overwhelming need to just make the pain stop.
And finally, there's confirmation bias. This is a sneaky one. Once we've made a decision, doesn't matter if it's to buy or to sell, our brain actively goes out and looks for information that tells us we were right. We build ourselves this comfortable little echo chamber, and we filter out anything that might challenge the choice we already made.
And this bias works both ways, creating these perfect little traps. If you buy at the top, you fall right into the bull trap. You read every positive article, you watch every optimistic news report, and you completely ignore all the warning signs. If you sell at the bottom, you fall into the bear trap. You go looking for negative news to prove you made the right call, which causes you to completely miss the market's eventual recovery.
So when you combine all these forces, our powerful emotions, our herd mentality, and our own tricky mental biases, they create a predictable and, let's be honest, an often destructive loop. So let's put it all together and see what this cycle actually looks like in action.
Just look at how perfectly out of sync our actions are with the market. At the very bottom, the point of maximum opportunity, what are we doing? We're overwhelmed by panic and we sell everything. Then, as the market starts to recover, we're skeptical, so we watch from the sidelines, missing all the easy gains. Then, at the absolute peak, when the risk is highest, that feeling of euphoria finally convinces us to buy in. And as the market inevitably falls, we're in denial, just holding on, until fear turns back into panic, and the whole cycle begins all over again.
So what on earth can we do about all this? Well, the key isn't some secret trading strategy or a hot stock tip. It's much simpler. It's awareness. It's understanding that these emotional and psychological forces are basically hardwired into our DNA. Just knowing that these traps exist is the most crucial first step you can possibly take toward not falling into them.
And that really brings us to the final question. We've laid out the map of these psychological minefields. The real challenge now is turning that map inward and looking at yourself. The next time you feel that pull of FOMO or the pure panic of a market drop, will you recognize the trap before you step in it?